Happy Thursday, everybody. Welcome to Liberty Call. It is Thursday, February 1st, 2024. Hope everybody's having a fantastical day out there. It's a beautiful day here in Colorado. The sun is out there. There's not a cloud in the sky. But it's just, unfortunately, an omen of the bad news we got coming tomorrow. We got snow, and more snow over Friday and Saturday. So, yay! So I get to clear the driveway on Sunday before my wife heads out of town again for some business. So anyways, if it is your first time watching the Liberty Call, I am glad you were here. You can see my main man, Jake, back here. He is ready for some ball time because, again, the weather's going to be crappy the next couple of days, so we got to get our outside time in now. So, but again, if it is your first time watching this show, if you could, give me some thumbs up, likes, shares, subscribes, follows, and press that notification bell because you don't want to miss out on all this genius. I mean, I once or twice a week share something that's of some real and important value. The rest of it's just nonsense. All right, let's go ahead and get into today's numbers. Markets bounced back pretty decently after yesterday's collapse. Dow Jones was up 0.97%, 369 points, closed at 38,519. S&P 500 up 1.19%, closed at 4906. NASDAQ up 1.3%, closed at 15,361. The VIX fell 2.16 today. It's at 1404. Canada was up 0.46. Brazil was up 0.38. And Mexico up 0.76. All right. Over in Europe, Germany was down 0.26%. UK down 0.11%. France down 0.89%. The Netherlands was up 0.47%. Spain down 0.63%, Italy down 0.18%, Switzerland down 1.05%, and Portugal down 0.59%. Russian exchanges were split today. MOEX up 0.34%, RTSI down 0.2%. And the Asian markets, starting out with the Nikkei in Japan, it was down 0.9%, Australia down 1.2%, New Zealand up 0.11%. In China, the Shanghai was down 0.64%, the Shenzhen component up 0.34%. China 50 was down 0.1%, DJ Shanghai down 0.45%, Hang Seng up 0.52%, and the Taiwan weighted appears to have been closed again. All right. So, like I said, after yesterday's collapse, after the Fed meeting, it looks like we have a nice little rebound today. We'll see if that holds. I don't have a lot of hope, but we'll see. All right, today's market recap. U.S. stocks rebound as dip buyers emerge from Fed-fueled tumble. Yeah, because the Fed caused that. There were just too many people hoping and praying that the Fed was going to be like, yeah, we're going to start cutting rates majorly in March. Because then the market would have been like, woo! All right, on Thursday, U.S. stocks rebounded from the previous day's Federal Reserve-induced sell-off, with tech stocks leading the rally. The dip in tech stocks attracted buyers ahead of major tech companies' earnings reports, including Amazon, Apple, and Meta. The rebound in the tech sector was notable as investors sought bargains following the Fed's decision not to cut interest rates in March. They still have to have the March meeting. They're just saying right now that looks like, based on the data, that we're not going to be cutting rates this quarter. Amazon, Apple, and Meta platforms were set to report their earnings later in the day. The positive sentiment in tech helped lift the broader market with a sea of green across stocks. Semiconductor stocks experienced a slight uptick, although a 4% decline in Qualcomm limited gains in the sector. Investor concerns about a maturing 5G smartphone market and potential market share losses contributed to Qualcomm's decline, according to a note from Morgan Stanley. Meanwhile, Peloton Interactive faced a significant setback, with its stock plummeting 23% after the fitness company provided a weak outlook for revenue and free cash flow. And yeah, since the pandemic ended, there was a brief stretch there for Peloton when everyone was staying home. They were buying, exercise bikes and all sorts of, exercise equipment to work out at home, since they figured they're going to be stuck. Based on looking around the public, I don't think a lot of them used it because they're all fat asses. But Peloton was like through the roof for that, in 2020, and then it just fell off like a cliff. Let's see here. Of the fitness company, weak outlook for revenue and free cash flow. Royal Caribbean Cruise Lines initially reported quarterly results and guidance that surpassed Wall Street estimates due to robust demand for cruise vacations. However, the stock later gave up its gains. Merck saw a positive response from investors, with its stock rising over 4% after the drug maker posted better than expected fourth quarter results. The strong performance was attributed to robust sales of its cancer immunotherapy, Keytruda, currently the world's top-selling prescription medicine. In economic news, initial jobless claims rose to 224,000 in the week ending January 27th, the highest level since mid-November. The uptick comes ahead of the monthly non-farm payrolls report, which is expected to show a decline in job creation. Analysts noted potential strains on the middle-class households dealing with slowing wage gains and inflation fatigue. Well, we wouldn't have inflation fatigue if you hadn't printed all that money 4 years ago, but hey, you had to save the world. I mean, we can't fault them. Yes, we can. The Federal Reserve's decision to keep interest rates unchanged, along with Chair Jerome Powell's comments tempering expectations of imminent rate cuts, had triggered the previous day's sell-off. Morgan Stanley estimated that payrolls rose by 214,000 in January, with expected wage growth at 0.3% on the month. All right, so that's what's going on in the markets today. Let's dive a little deeper into some data. Strong U.S. worker productivity keeps labor costs in check for the fourth quarter. U.S. worker productivity exceeded expectations in Q4 of last year, growing at an annualized rate of 3.2%, helping keep unit labor costs in check. The rise in productivity, along with a gradually fading labor market momentum, provides additional support to the Federal Reserve's efforts to combat inflation. The central bank had recently left interest rates unchanged, but hinted at lower rates in the coming months. Yeah, several months. First-time applications for unemployment benefits increased to a 2-month high last week, and the number of people on unemployment rolls reached its highest level in 2 months. Compensation costs rose in Q4 at the slowest pace since 2021. Non-farm productivity, measuring hourly output per worker, exceeded expectations, growing at a 3.2% annualized rate in Q4, compared to economists' forecasts of 2.5%. The productivity expansion averaged 1.2% in 2023, rebounding from a 1.9% contraction in 2022. Labor market indicators, including rising jobless claims and the highest number of people receiving benefits since November, suggest a gradual easing of labor market momentum. Unit labor costs rebounded at a 0.5% rate in Q4, while hourly compensation increased at a 3.7% pace. The moderation in labor costs brings the Fed closer to achieving its inflation target. Yeah, it's still... Inflation is like 3, and the target's 2, so that's what, 50% higher. Despite a surge in job cuts announced by U.S.-based employers in January, the labor market remains resilient, supporting consumer spending and housing demand. The upcoming non-farm payrolls report for January is expected to show an increase of 180,000 jobs, with the unemployment rate forecasted to rise up to 3.8%. Solid demand for goods is contributing to the construction sector's growth as construction spending increased by 0.9% in December. Additionally, manufacturing is on the verge of recovery in January, reflecting a positive sentiment among manufacturers. Overall, the reports indicate a balancing act in the U.S. economy, with productivity gains, moderate labor costs, and a resilient labor market contributing to the Federal Reserve's inflation-fighting efforts. Again, it's like arsonists who start the fire and then come and put it out and then want a reward. It just, it doesn't make a lot of sense. All right, last up comes from Zero Hedge. This article is titled Manufacturing Survey Shows Rebound in January, but Prices Are Soaring. All right. Manufacturing surveys in January signaled a robust rebound, with the S&P Global's manufacturing PMI spiking from 47.9 in December to a final reading of 50.7. Similarly, the ISM's manufacturing PMI rose from 47.1, revised lower in December, to 49.1 in January, surpassing the expected 47.2. While both PMI readings remained below 50%, indicating expansion, they marked a significant improvement, with S&P Global's print reaching its highest since September of 22. The 5.5 increase in orders in the orders index within the PMI data represented the largest monthly advance over 3 years. Despite the positive trend, the PMI's employment index deteriorated further, remaining below 50 for the 4th consecutive month. Chris Williamson, chief business economist at S&P Global Market Intelligence, noted that manufacturers started the year optimistically with a surge in business optimism about the future. New orders increased at a pace not seen for over a year and a half, especially in consumer goods, where demand improved amid signs of easing inflation and looser financial conditions. However, amid the positive outlook, there are concerns about rising factory costs due to supply delays, including adverse weather and disruptions to global shipping. Higher costs are translating into increased prices for goods, with factory prices rising in January at the fastest pace since last April. If these inflationary trends persist, there could be a renewed upward pressure on consumer prices in the coming months, which means more inflation for you and me. The overall positive manufacturing data aligns with the backdrop of strengthening hard data, reflecting increased demand, rising new orders, and signs of restocking. Despite challenges such as supply chain disruptions, manufacturers are showing resilience and optimism about the year ahead. Yeah, but if inflation rebounds, the talk of lower cutting rates is not going to happen anytime soon. And, if it rebounds too high, then who knows where that sends us. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.